Hello, this is Mitam Television exploring United States stocks. This video is being broadcast simultaneously on our Mitam Television channel through a partnership with Mijun Television. Welcome to the United States Blue Chip Stock Analysis segment, where we examine some of the top quality companies listed in the United States. Based on data, we review the current situations, and through this process, this segment is designed to help you make investment decisions and choices based on data. What's the stock we're going to cover today? It's a company called Cadence Design Systems, and its ticker is CDNS. This company provides software that's essential for designing semiconductors. They make electronic design automation software, which helps design, draw, and verify whether the semiconductor design programs are properly set up. So they sell these services to semiconductor design companies and earn money by charging usage fees for those services. That's their business model. Let's take a look at this company one by one. Recently, second quarter earnings reports have been coming out continuously. So in the blue chip stock analysis section, we've covered some good companies, but as new earnings are released, there are some points to check or changes to note. I'll include and explain those companies that have shown some changes along the way. Today, Cadence Design Systems is one of those companies. If you look at the stock price movement over the past year, it was basically moving back and forth in a big range between about $250 and $320. But recently, there has been some movement breaking out of that range. Then yesterday, Cadence Design Systems announced its second quarter earnings, and the stock surged. Before the market opened, it was up by more than 6%, but in reality it went up by almost 10% as they announced very strong earnings. Not only this company, but also its competitor Synopsys saw its stock price surge by about 7 to 8%, showing a simultaneous upward trend. The recent Q2 earnings report showed revenue of $1.27 billion, a 20% increase from the previous year. Next adjustment. Earnings per share was $1.65, which exceeded the consensus analyst expectations. And then the company also raised its guidance for the end of this year. Overall, this is a company whose stock price has been performing quite well. As I mentioned earlier, this company has a variety of automation solutions needed for the semiconductor industry, such as electronic design automation, system on chip, and even printed circuit board design. So compared to its competitor Synopsys, its market capitalization is similar, the revenue size is not much different, and the operating profit is also similar. So they are growing together while keeping pace with each other. If you combine the market shares of these two companies, they account for about 80% of the electronic design automation sector, so it's basically an oligopoly with the market divided between them. Since they compete with each other, each company has its own specialized areas, and recently, both companies have been focusing on these specialties. These companies are making a lot of moves to expand their size and secure their positions through M&A. As I mentioned earlier, the core business division is integrated circuit, which refers to semiconductor chips. There are software tools needed for system-on-chip design, and these are called core electronic design automation. This accounts for about 78% of their sales, and the growth in this area is improving significantly because artificial intelligence and semiconductor-related production continue to increase, leading to recurring subscription revenues for related designs and similar areas. In fact, when I looked at the data, this company announced in the second quarter, about 70% of their total sales come from recurring revenue. That means, like a subscription service, sales are consistently generated on a recurring basis. So, instead of volatility, the company is able to secure a fairly stable revenue stream. This shows that the company's stability and the predictability of its business model are quite high. And since these electronic design automation tools are closely linked with things like semiconductor design and other related processes within a company, it's not easy in reality to switch to another company's electronic design automation tools. So these aspects are what we call switching costs, the costs that occur when changing services to another company. This business model has quite high switching costs. These aspects can be considered one of the factors that Warren Buffett mentioned as having an economic moat. So that's actually a really good thing. it's a structure where it's not easy to switch to a competitor's service, and that's what gives Synopsys its own strength and Cadence Design its own strength as well. Recently, one of the risks is that they got caught violating United States government export regulations. They have a subsidiary in China, and through that subsidiary, they supplied software to a Chinese military university. Because of this, they were fined and had assets confiscated, along with other civil settlements, resulting in a total penalty and confiscation amounting to about $140 million. Actually, this wasn't the first time this news came out. Before that, these things were discovered and there were ongoing lawsuits, and the final settlement amount they agreed to pay is about $140 million, which is quite a large sum. But this itself had already been reflected in the stock price as bad news before, and now the amount has been finalized. I think this will probably be reflected in the second quarter's earnings. Is it a solid company? Let's take a look at some data. It scored 81 points, ranking 99th among all listed United States companies, placing it in the top 1%. That's impressive. Compared to others that score around 90 or 100 points, this company's growth potential is lower. It's crucial for them to recover their growth potential in this area. Looking at the overall score over the past year, it's been consistently maintaining around 80 points, so you can consider it a top-tier company. So in the end, this company falls into the category of really good companies where it's possible to buy at a price that's not too expensive and sell at a higher price. That's how you can look at it. Now, let's take a look at the financial chart. If you visit our ChoiceTalk website, you can search and view all these charts for free. As I mentioned earlier, in the most recent 2 quarters, sales increased by about 20% and earnings per share grew by about 29%, so we can evaluate this as a stable growth stock with steadily rising sales, profits, and net income. However, if you look at the operating profit margin, the recent annual operating profit margin is 30%, while the net profit margin is 22%. If you look here, you'll see that the gap between the blue line and the green line on the right has widened significantly. If you look at it recently, it decreased a bit, but then increased again. In the end, the operating profit margin is improving, but the net profit margin is actually declining. So this is slightly lowering the growth rate of earnings per share and net profit. The question is, what's the reason for this? If the reason comes from a fundamental issue within the company, then we need to take that into account when considering the valuation. But if it's due to external factors or something unavoidable, then even if the profit margin has decreased, maybe it's not a big problem. You can just skip over it. So let's check those parts together. Now let's take a look here. Now, this company's financial costs have increased a bit. The reason for the increase is that the company took on more debt, and the reason for taking on this debt was to use it for M&A. So, there was an increase in financial costs, but an even bigger part is the corporate tax. If you look at the corporate tax on a quarterly basis recently, it has increased quite a lot. If you look at the data from 2021 onwards on an annual basis, it increased to $340 million last year. If you look at this in terms of the actual effective tax rate, it jumped significantly from about 18.8% to 24.4%. So the tax rate increased by about 6 percentage points, and this played a significant role in reducing the net profit margin. The tax rates increased significantly for 2 reasons. First, as taxable income profits went up, the corporate tax in each bracket also increased. Therefore, the rise in taxable income led to an increase in taxes. But what's more important is this part. There are R&D credit limits in California, and since we've already exceeded that amount, the portions that go beyond what was being credited are now fully taxed as corporate tax. That's why corporate taxes have increased significantly. On the other hand, in the case of a competitor like Synopsys, their corporate tax rate is quite low. So, KC Design System is located elsewhere, and they're also making good use of various credits and incentives provided by the United States government. While their sales are similar, there's a noticeable difference in their operating profit and net income. The reason why Synopsys is higher and Cadence is lower is due to corporate tax issues. Anyway, this company is already taking advantage of all possible deductions and such, so it's not easy to reduce the profit margin any further. So, we need to increase the operating profit margin and sales revenue to grow the overall net profit itself. The Cadence Design System seems like a good idea. A company with a positive operating cash flow and negative investing and financing cash flows on its statement is considered financially solid. That's a good form. If you look at the green part recently, financing activities are at 0 here, but below it's negative and above it's positive. This part is positive, but if you look here, it suddenly spikes, the green shoots up. This part means that financing activities have increased a lot, so it became positive. I told you before that in cash flow, a plus means money came in and a minus means money went out. So, the fact that financing activities have surged into the positive means that money has flowed into the company through borrowing or capital increase. So, that means they borrowed money. In fact, if you look at it, their borrowings jumped from $650 million to $2.47 billion. This part ultimately appears as a positive in financing activities on the cash flow statement. Now, where did they use this money? That's something you check on the balance sheet, and when I looked into it, in June 2024, they acquired Swiss Beta computer-aided engineering systems. They spent about $1.3 billion on this. So, by acquiring this company, they spent money to strengthen semiconductor design-related, and artificial intelligence-related processing and other capabilities. In the case of competitors, Synopsys is also a listed company like NCIS, and they acquired this company in July of this year. So the final amount has been confirmed and they've decided to go through with the final acquisition. So Synopsys and Cadence design systems are securing areas where they were previously lacking and are now setting strategies to expand their business areas. So there's a strong possibility that competition will intensify even further. Recently, if you look here, the return on equity has dropped a lot. When return on equity drops, valuation also tends to decrease. The reason for this is because of the net profit margin I mentioned earlier. Return on equity is made up of 3 things, including the net profit margin. So we can break it down into 3 factors: net profit margin, sales growth rate, and the ratio of debt to assets or leverage. These 3 are multiplied together. For this company, things like sales growth or leverage are actually okay. In fact, leverage has increased because they've used more debt. But since the net profit margin itself has dropped due to issues like corporate taxes, the return on equity has also decreased. So, rather than seeing the drop in return on equity as a problem with the company's fundamental profitability, it's more that they've started making so much money that they've exceeded the deduction limit and now have to pay corporate taxes. I think it would be a bit more reasonable to understand it this way. Next, if you look at the stock price and earnings per share chart, I mentioned that the stock price moves according to the direction, speed and growth rate of the earnings per share. Cadence Design Systems had been stuck in a box range, but recently it's starting to break out of that range. When these kinds of movements occur, there's a high possibility that the stock price will gain upward momentum, and at that time, with good earnings coming out, the stock price surged in this kind of structure. If you look at the expected earnings over the next 3 years, it's about 12% annual growth on average, so it's showing a moderate level of growth. The earnings per share growth rates are 12%, 27% and 17%. This year's 12% is low compared to sales growth. Typically, profit growth should exceed sales growth. For companies with this kind of recurring revenue, what's the reason this year is relatively low? As I mentioned earlier, the increase in financial costs and the rise in corporate taxes are included, so that's why it's a bit lower. After that, since it's between 17% and 27%, it means they're maintaining a stable, moderate level of growth. And because they have a high level of recurring revenue with strong visibility into their performance, you can see that this is the kind of company they are. The past year's valuation data indicates that the red areas are greatly overvalued. So you can also check this valuation on our Chose to Check platform, and instead of using the securities firm's consensus, we use our own artificial intelligence engine and quant algorithm to calculate the valuation ourselves. So at this time, it's overvalued, and if you look at the yellow area, that's when it was undervalued, which was actually a really good time to buy the stock. But if you look at the chart, things might look tangled or in a reverse order. However, regular stock charts don't tell you about the valuation. They just quickly show you the current situation and the direction things are heading. To determine if something is cheap or expensive, look at the valuation chart, not the stock price chart. So if you look at this, the cheapest period for Cadence Design System in the past year was right here, and now the stock price has gone up to this point. The stock is currently between fair value and overvalued. As earnings are released and the price rises, it will likely move closer to the overvalued range. The overall fair stock price for this area will be adjusted based on the earnings reports. Since the shaded area, which we call the band, will also move up to the upper side, it's likely to grow at this kind of annual average rate. That's how you can look at it. If you look at the exponential moving average chart, there was a golden cross around May, so this is the midterm. So as the 21-day line breaks through the 61-day line and moves upward, we're seeing an overall strengthening of the upward trend. Let's move to our website, take a look at the current state of the Cadence design system, and then wrap up. Looking at the Cadence design system, it ended yesterday up by 9.7%. Earlier, it was up 6% before the market opened, but in reality, it ended up around 9.7%. Our system gave a buy signal on April 28th. The stock price had been stuck in a range for quite a while, but recently it became a case where the price went up. If you look here, we sold once at this point, but as the trend started to fall, the artificial intelligence trading signal marked it as a sell, thinking this wasn't the right time. And while it was stuck in this range, the system caught a buy signal at this point. After that, the price went up and then dropped again, so we thought another sell signal might come out. Fortunately, it held well at the bottom, and yesterday it jumped up, so overall it's now showing some movement toward an upward trend. Next, if you look at the valuation, it was the cheapest at that time, and now it's risen up to this point. So it's clear that the current price level is a bit burdensome. So when you look at these companies, if the score is high, the valuation is low, and then, as I mentioned earlier, the exponential moving average chart is at the very front. You can look at this in the short term or in the midterm. The short-term movements tend to turn around this time, which is around the end of April. At this point, all three conditions need to be met. In our artificial intelligence trading signals, a buy signal appears. So for now, those who are holding should continue to hold during this period, but for new buyers, since the price has surged recently, it might be a bit burdensome to buy at this price. If you look here, you can see the news as well. Cadence Design's second quarter sales are rising, and the Apple News and Edgar Flash news we provide are shown here. In fact, as soon as the earnings report comes out at 5:04, whether it's early morning or late at night, it gets updated immediately. So when an earnings article or an 8K disclosure comes out, we actually provide it in Korean within about a minute. And on top of that, we even provide analysis for you. The text below indicates that the anticipated increase in earnings is predicted to favorably affect the stock price. Our artificial intelligence discusses the stock price impact and presents that information to you. We write the article content ourselves and show it to you like this. You can mark articles with a heart on the right side to add them to your favorites. So if you do that, whenever an article comes out, if you install the ChoiceStar app, you'll get a push notification. You don't have to keep checking whether a new article has come out or if there's any news about the stocks you own. You'll be notified upon arrival, so you can check it immediately. It will help you make trading decisions, so make sure to install the app, add your stocks of interest, and try out the news and Apple News features for yourself. If you liked this video, please subscribe, like, comment, and support. Thanks.